What is going on, guys? Welcome in. This is the class recording to the Selling Options Like a Market Maker class that we did this past week in T-Trade's Discord. I want to personally thank TT for the opportunity. I will be sure to drop the link to this presentation below in the description. Let's get right into it. All right, the first thing to note here is brokerages to use. I have them listed below left to right, ranking novice to advanced. Robinhood needing no trading experience, Webull and TD moderate to advanced, and then Interactive Broker is more so for foreign use. My preference is Webull above all of their brokerages because the user interface is nice and the fees on Webull are enough to keep me on Webull. What I mean by that is that TD Ameritrade, Interactive Broker, Thinkorswim, those are going to charge you 65 cents per entry and exit on a contract. So every contract you enter and exit, you're paying $1.30. If you're trading upwards of 50 to 60 contracts like me per week, that's really going to start adding up. And then at the end of the year, you might be paying $2,000 to $3,000 in fees, whereas on Webull, that might be $200 to $300. The next point here, and the largest benefit to this presentation, is the time requirement. Selling options can be done with weekend analysis and 10 minutes throughout your trading day to open and close your positions. Time is on your side with this trading strategy. If you're busy throughout the day with a full-time job, you're taking care of kids, or you're opening positions day trading wise and you want trades running in the background, this is your trading strategy. You're going to look at 5 to 7% per month instead of that 5 to 7% APY. So if you have that money sitting there, this is where you need to be investing it. ThetaK is the amount an option decreases over time, no matter how the stock moves. You're going to make a specific amount of money over every 24-hour period that you're in that option. So, for example, stock ABC moves sideways for 2 days. With a ThetaK value of 0.25, the option will decrease in value by $50 over those 2 days. If you're buying naked options, this isn't what you usually want to hold through, but if you're selling options like we're doing here, that ThetaK is pure profit for you. So if you like to trade Tesla, if you like to trade AMD, if you're selling an option on Tesla at a 180 strike, you're selling a put on Tesla at 180, that contract, let's say you get $500 back for selling that put, that contract will lose about $100 per day for that week. So you'll be making $100 per day just by having that asset sitting there. If it goes below that 180 strike, you add the shares. If it stays above 180, you keep the full premium, you keep the full $500, and you also get your money back that you put into that investment in the first place. If you get called on it, you just buy the shares of Tesla at 180. You can sell it back whenever. You don't have to be in the position the entire time. But again, this is very good for people that don't have time to look at the charts all day. If you're working a full-time job, this is something that is going to get you an incredible amount of passive income on the side. The next thing is long calls versus covered calls. So these covered calls are what you sell for selling options. So long calls, if you don't know, you expect the price of a stock to go up. So you buy a call, your profit is based on the stock's appreciation over time. Versus a covered call, if you expect the stock price to go down, you can sell a covered call that will protect you for the downside. You also get to receive premium in return. If you look, or if you have your brokerage open right now, you can go and look at a 180 call on Tesla, whatever call option you want to look at. You're looking at the premium on the option, so how much it costs you to be able to buy the option. That's what you're getting in return for opening the position. So for next week's expiration, a 175 call on Tesla right now is $400. You get that $400 as soon as you open that position. So as soon as you sell that 175 call, you get $400. That's your weekly gain. If Tesla goes up above 175, your profit is you sell the shares for whatever you bought them for. So say you bought them at 170, you sell them at 175, so you make $5 per share there. And then you also pocket $400 in premium, so your profit for the week would be $900 on a $17,000 investment. Again, very suited towards people that have a full-time career, full-time job. You're not able to look at the charts all day. This is what you want to do. The next thing is a long put or a cash secured put. This is my personal favorite. This is what I do every week. The simplest form of doing this is you wait for red days to sell into. So a cash secured put is essentially like buying at a discount. I relate this mostly to Black Friday or Cyber Monday. You know for the entire year that you want to buy something. There's a 50-inch Samsung TV that you want to go buy. You're not going to buy it this weekend for the $1,200 that it's worth. You're going to wait until Black Friday to maybe get a 20%, 30% discount on that item. Instead of buying it for $1,200, you are patient enough to wait. You buy it for $800, $900 if it's 30% off. You buy it for that price, you save that $300, and then you also get the asset that you're looking for. So that's what cash secured puts are in the simplest form. That's the easiest way to understand them. Using both of these together is the wheel. I won't dig too much into this because it's a little more complicated than I would like to cover today. But the wheel is essentially using cash secured puts and covered calls to wheel in and out of a asset, Tesla, AMD, any stock that you want. It's the way that you get in and out of that asset for a profit over a short period of time. This is an example of what I'm doing every day, every week. So I'm doing about 5 to 7.5% a month on large amounts of capital. In this example, I own 900 shares of Tesla at 180 right now. So my investment is $162,000, and this is on a weekly basis. My investment's $162,000. In this example, what I did, because I own the shares at 180, I'm expecting downside in Tesla. I sold a 185 covered call last week. I sold it for $445. I bought it back for $124 each. Oops. So right here. So I sold it for $445, bought it back for $124. So my profit per contract that I open is just the $445. I sold it for more, bought it back low. My profit per contract is $321 times 9 because I had 9 contracts. I made $2,900 over the course of those 2 days. And then I also, the following day, Tesla had a nice pump up. So I sold another 177.5 call at $335. I bought that back at $63. So my profit on that was $335 minus that $63, $272 per contract multiplied by 9, $2,448. So my capital deployed for the week, because I own 900 shares of Tesla, my capital deployed is $162,000. I got a $5,337 return. This scales perfectly to whatever your account size would be. So say you only have $10,000 to invest, you can buy assets like, instead of Tesla, you can go and buy an asset of TSLL, which is the leverage version of it. If you don't have enough to buy 100 shares of Tesla, you can go and buy this for $700 on 100 shares. You get the same weekly return as this. So it's a 3.2% weekly return, or in this case, I did it in 3 days. 3.2% times however much capital you have to invest. If you have 100,000 to invest, that's 100,000 times 0.032. You'll get $3,200 for that week. If you only have 10,000, you'll get $320 for that week. The big picture here is that you're compounding your gains over time. What you want to do is you mainly just want to use the capital that you have sitting there. If you have that money sitting there, you're not using it for anything, it's sitting in your Roth IRA, it's sitting in your investment account, you want to use that capital to your advantage and have that build you passive income over the week, over the month, and so on. Individual first. What I do as a trader is every time I assess the position that I'm getting into, I go over, is it profitable? Is it not profitable? So it's just this is as simple as this. If you guys want to screenshot this chart right now, if you're profitable, you go over to, is it consistent? If it's consistently profitable, you keep doing it. You always want to make sure that you're back testing this chart. If you're profitable for, let's say, 2 weeks, and then you stop becoming profitable because you weren't back testing the chart, and this turns into a no, what you want to do is you want to adopt a new strategy, make sure that strategy is profitable, and then go back to the consistent model. If it's not consistent, you back test it again, continue doing that. What you want to do is every Sunday night, You want to make sure that you're back testing the strategies that you're using Sunday night, Saturday morning, either or. You want to back test what you did for the week. You want to assess what you did for picks that week, what you did for profit, if you were consistently profitable. If you weren't, you just continue to back test it until you are. That's the simplest form of investing. Now, what you want to do for understanding the personality of stocks, I pretty much mainly trade Tesla. I don't trade many other names. I trade Soxel as well. So this is a Philadelphia Semiconductor ETF. You want to focus on one stock because each stock in the market has its own personality. Your job is to identify what the personality of that stock is. So for Tesla, for instance, if you're a Tesla holder like me, you know that this stock is a very volatile mover. It moves up about 2% a day on average, up or down 2% a day on average. So what you want to do is you want to look at the stock and you want to identify the patterns that it has. One that I've identified just from watching it for an extended period of time, Tesla, whatever the first 5-minute candle of Tesla is, so in this case, the first opening candle was green right here, $1.47 up. Tesla inverses that candle until 11 to 12 o'clock. Once it makes its bottom for the day or its top, it then reverses until close for the remainder of the day. And this is a perfect example of what it does. We have a green opening candle at 9:30. We retrace that candle down until 10:30 today, and then we reverse that move, and we're currently at 217. We reverse that move. We have an hour and 50 left in the market. We'll likely close up here at 174. So if we go to the previous day, again, green candle to open, reverse that move until 10, and then we ended up going flat for the day. This was just because we had PPI today. People weren't wanting to they didn't want to get into trades to hold overnight. Previous day, again, first 5-minute candle, red. We reverse that candle up until 10, reverse that direction for the remainder of the day, and then we ended up closing relatively flat. And the account that I'm running right now, I'm doing a $10,000 to $100,000 account, just trading options to show people that you don't need the 164K that I had in this example. You can do it with a much lower amount of capital. You can still average that 5 to 7% gain per month. Obviously, every month you're not going to hit that gain. It is a passive form of income, but you're going to have some months that are bad. You're going to have some months that are really, really good. That's just part of the way of trading options. All right, that will conclude that portion of the class. I will leave the rest for the people that were in live attendance. Thank you to TT for the opportunity, and I will be sure to come back for some live sessions with you guys. Don't forget to like and subscribe in the video, comment any criticism you guys have, and I will make the adjustments for the following videos. Peace.